Are you feeling overwhelmed with where to start investing? Today, we're going to show you how we would invest our first $5,000. Welcome to Get Started Investing, a podcast where we help you make the most of your money. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. And how could we not be excited when we've got $5,000 in our hot little hands?
Yeah.
And we've been given the challenge from Betashares to say, how would we invest it?
Yes, and
unfortunately, they actually haven't given us $5,000. This is hypothetical.
And this episode was inspired by a question from our community member, Reza.
Hi guys, latecomer here. I'm in my mid-40s with two youngish kids. Got some money saved and the mortgage being offset by the savings and looking at investing in ETFs. Do you have any suggestions on how I should start building my portfolio considering I've got another, 20, 25 years to work? I'm looking forward to hear answers. And thanks for all the information you've given in your show.
Love it. Thanks for the question, Reza. We love hearing from you guys. Just a reminder, if you would like to ask a question, there's a link in the show notes or in the description below. As I said, please, we love hearing from you. But in today's episode, we will be covering our investing strategy and why it's simpler than you think to get started. We're going to walk through the steps to start investing with $5,000 and then break down our hypothetical portfolio for that $5,000. And I'm sure by the end of this, Reza, you'll have a few ideas on how to start investing into some ETFs.
Now, I mentioned that Betashares has given us the challenge to invest this $5,000. And Betashares is our long-term partner here at GSI, and we want to say a big thank you to them for supporting the show and helping us keep all of our content free.
That's right. On Betashares Direct, you can build your own investing journey with $0 brokerage on over 300 shares and all ETFs listed on the ASX.
Do you want a ready-made portfolio? There are over 10 to choose from, or you can build your own, like we're going to do today.
That's it. Automated investing lets you set, forget, and grow. If you want easy tax reporting or performance reporting, it's all there and unlike any other investment platform in Australia.
Building wealth your way has never been easier. Search Betashares Direct and set up your account in minutes.
Betashares Capital Limited is the issuer of Betashares Direct. You should read the PDS and TMD available at betashares.com.au and consider whether the product is right for you. Investing involves risk. Refer to the PDS for info on other fees and costs.
Now, the great thing about this challenge that we've got, Bryce, is if we're using Betashares Direct to invest this hypothetical $5,000, we're not just restricted to Betashares ETFs.
Yeah.
We've got every ASX listed ETF.
Yeah.
So that includes, a bunch of active managers as well as all the thematic and passive options.
Bitcoin.
Bitcoin ETFs,
Yes.
yeah, and Ethereum ETFs. It also is the top 300 ASX shares.
Yeah.
So as part of this challenge, we can invest in individual stocks as well. So we've got a lot to choose from. We've got a lot to choose from with zero brokerage, which is exciting. So when we get a challenge like this, where do we want to start?
With a disclaimer.
Okay. Yeah, all right. Well, for everyone listening, please note that this is general information only. Bryce and I are doing this hypothetically. We're not aware of your personal financial circumstances, so just keep that in mind. But where do we want to start after the disclaimer?
Look, it's always important to start with understanding what your goals are and what your risk tolerance is, because that's then going to really form the types of investments that you are willing to make. And I think if we look at Reza's situation, he said he's got some cash on the side. He has sort of like a 25-year time horizon, and so that is one place you can start.
Yeah, and look, that's the only personal information we know about Reza. So like, this isn't personal information or personal advice for him. But I think for a lot of us that we have that long-term time horizon, 20 plus years, we can really think long-term. We can invest in riskier assets. I think the other thing is risk tolerance. So you and I are comfortable with the risk of investing in the stock market. We're comfortable with the idea that, in the short term, medium term, we might see stock market falls like we've seen this year. The Australian market's down almost 10%, the US market about the same. That is just a fact of life, and that is a risk that we're willing to take because we know over the long term stock market history has trended up.
Yes.
Yeah.
I would also say that you need to be comfortable with your risk capacity. And what I mean by that is everything that you're putting into the market, Ren and I think of as something that we are not going to need in the short term.
Yeah.
This is not something that we're putting in the offset account or we're taking out of the offset account, and that offset account had our emergency savings in it. Like, we are not putting money in the market that is in any way, shape or form we're going to need to rely on in the short term.
Yeah. I think the sequencing that we think makes sense is build your emergency fund. So you've got that money. You don't need to go into debt or sell your investments if you do need cash in an emergency. Then get out of high interest consumer debt, because like the returns you're making by getting out of a 19% per annum credit card, that is building your wealth faster than, you know, the 8 to 10% returns you can expect over the long term on the stock market. And then once you've got those two sorted, then it's like, okay, now let's build some wealth.
Yeah.
And I think let's assume that's all taken place. Let's assume we've got our emergency funds sorted. The question then becomes, what are our options?
So I think with $5,000, you have a reasonable amount of money to consider a number of options. But just at a very high level, if we're looking at investing in the equity markets, you've got individual stocks, you've got active managers, and you've got ETFs. That's sort of the three buckets that you can choose from. Now, if you're going if you're going individual stocks, then you obviously need to put in the work to understand the investment thesis, research the companies, understand the financials, and build a portfolio of individual stocks. Similarly, active managers, you can give your money to a professional to look after, and similarly though, you need to understand what their strategy is, what their fees are, and the like. Or, as we've spoken about plenty of times here on Equity Mates, we are the index boys. So there's plenty of low-cost ETFs that are available that give you access to many different thematics and geographies around the world.
So when we think about those options and we apply them to our choices, I think we've obviously spoken about this before. We'll speak about it again. But we both like that core and satellite style of investing. And so in the show notes or the YouTube description, we'll include links to previous episodes we've done that explain core and satellite in more detail. But at a very high level, the core and satellite is sort of founded on the belief that it's really hard to beat the overall market over the long term. So you want to start by having the majority of your assets in that core portfolio that is just tracking the global stock market. So you want it to be low cost. You want it to be globally diversified. You want it to be market cap weighted, which just means you have more of the big stocks and less of the small stocks. And you just want to just set and forget. That's the boring, slow growing, consistent core of your portfolio. And then the satellite on the side is the active managers, the thematic ETFs, the individual stocks, the crypto potentially, whatever it is, that where you're trying to get a return above the market, but you do so knowing that it's hard to do. I think the stats, the S&P Global have their SPIVA scorecard, and over the past 10 years in Australia, only 17.8% of Australian active managers have managed to beat the ASX 200. So that's why we like core and satellite, because we try and beat the market, but we know it's really hard to do.
Yeah. And that's the stat when I first started as well. It's like, I wish I'd known that stat earlier, because it really takes away the feeling as an investor that you have to be trying to beat the market, that you have to be picking stocks, and you're not a successful investor if you're just taking the market return.
Would have made our investing lives a lot easier. May have meant we never started this podcast though.
True.
Yeah.
True. Yeah. I mean, if you do follow what we've set out in our book, Don't Stress, Just Invest, you will never have to listen to this podcast ever again.
Yeah. All right, Bryce. Well, I think that is enough of a run-in. We've established our goals, thought about our risk tolerance and our time horizon. We've explored the options out there, and we've landed on our preferred strategy to invest these $5,000.
Yeah.
Without any further ado, now let's get to what I'm sure people are actually waiting to hear, which is how we would allocate this hypothetical money.
Can I do two options?
I mean, yeah, it's your show. You can do as much as you want.
All right. I'll start by saying, if you want to take the easiest, but by no means the worst approach, if you want to take the easiest approach, it's the one-stop shop ETF.
Yes.
And that is just putting $5,000 in one ETF that gives you global, diversified, low-cost exposure. So there are plenty of options. One that we've spoken about a lot is Betashares Diversified All Growth ETF, DHHF. Gives you exposure to international markets, markets here in Australia, emerging markets, and is 100% equities. It's low cost. I think it's 0.19% per annum. Vanguard have one. It's called the Vanguard Diversified All Growth, VDAL. Now, both of these, you can put in $5,000 and they will do the work for you. You don't have to pick stocks. You don't have to pick ETFs. So that's where I would start if I just wanted to invest and get on with life.
Well, let me ask you a question. So Betashares have DHHF.
Yeah.
They also have a moderately geared version,
Yes.
GHHF.
Yeah.
Why would you go D over G?
I would actually go G, but I went D just for the simplicity of not having to bring in the concept of leverage.
Okay.
Yeah. But if you want to go down a rabbit hole on
Well,
that,
now I've brought it in.
Now Ren's brought it in. We've done an episode on GHHF. We'll put a link in the show notes, but it does give you a little bit of leverage, I think to the tune of about 30%, so moderately leveraged, which really means that for every dollar that you're putting in, you're getting an extra 30 cents. And so you're getting increased exposure.
Yeah.
Which, nothing wrong with that.
Yeah, which makes it more volatile. Like the highs are higher and the lows are lower. And so it's a question of your risk tolerance and your time horizon. But it is another option.
Yeah.
So you wanted to sit on the fence and you wanted to give two options.
Yes.
One was an all-in-one ETF,
Yeah.
and you've given us three names there to think about.
Yeah.
What's your second option?
The second is more what I currently do, which is to still take the $5,000, but probably be a little bit more in control of where that goes across my core portfolio. So I would split it into 40% I'd be putting into the US. So Betashares, I currently invest in one called GGUS. It's a geared US exposure. iShares also have a very popular one, IVV. So I'd do 40% in that. Then I'd split the remaining 60% between Australia, the A200, VAE, which is Asia ex Japan, and Europe, VEQ.
Now, for people who have been listening to Get Started Investing for a while, they might be getting a sense of deja vu, because that's essentially how we both actually set up our core portfolio.
Yeah, well, we don't want to give the impression. We don't want to give the impression here at Get Started Investing that we don't practice what we preach.
Yeah, of course, yes.
And I guess what's missing here is, for me, is individual stocks. And that is because I think at this stage, getting 5,000 to 10,000 is the name of the game. And yes, you can do that through individual stocks, but I think if it's the first 5,000 that you're putting in, and we'll talk about automation and that stuff in a moment, but I think you want to build up a reasonable chunk in your core before then starting having a play around.
Yeah, and I think the lesson that we've learned over and over again is you constantly feel like you need to do more as an investor, but you don't.
Yeah.
The core portfolio can be enough.
Yeah.
The all-in-one ETF can be enough.
Yeah.
And there's just this feeling that there's so much opportunity out there. You have to keep exploring what the next one and the next one is.
Yeah.
But actually what will make the biggest difference in your long-term wealth building journey is improving your cash flow, spending less than you're earning, putting more in the market, and just building that core portfolio. Because of everything we keep saying, that it is hard for active managers and stock pickers to beat the index over the long term.
Yeah. So that's how I would do it. What about you, Ren?
So you've just done a core portfolio.
Yeah.
I want to bring the satellite exposure
Nice.
in, because I think the platform that you're on makes a difference, and Betashares Direct is no brokerage. So that means that as you're investing in stocks or ETFs, they're not charging you to do that.
Yeah.
And so that does mean that I felt more comfortable going to, I guess, like smaller investment size. Whereas, like, if I was on a platform where I was getting charged $9 brokerage, I wouldn't want to invest in smaller chunks because you're getting slugged $9 every time.
Yes.
And it doesn't feel like a lot, but it can add up. And especially if this is just the initial portfolio setup, and then the idea is every time we get paid, we add to this portfolio. If I've got, 6 or 7 lines on my portfolio and I'm getting charged, 7 nines are 63 each time I invest each fortnight, like that adds up over time, and that can erode your returns. But the good news, Betashares Direct doesn't have brokerage, so I have got heaps of lines here.
All right, settle in.
So let's start with my core portfolio. I've allocated 60% of the $5,000 to my core portfolio. And unsurprisingly, it's across the 4 ETFs that Bryce also mentioned. Not the geared ones, but I've split it evenly. So 15% or $750 into Australian ETF, either like A200 or IOZ or VAS. $750 or 15% into the S&P 500, the US. So that could be an IVV. 15% into Asia, which could be VAE. And then 15% into Europe, which could be VEQ. So that's my core.
Nice.
Done. We don't really need to speak about it because it's exactly what you spoke about.
$3,000.
$3,000, 60%.
Yeah.
So then I've got 40% remaining, and I've got 3 more lines here. So I'm taking 10% of the money and putting it into a high growth active manager.
Nice.
And for me, that's just because I want some additional exposure to, we've obviously got like big US tech in that S&P 500, but I want an active manager who's actively out there trying to find like those fast growing tech names that are really exciting and that are moving the market. And so I've got 3 options. I don't think any of them are bad options. Hyperion Global Growth, which is HYGG. Monroe Global Growth, which is MAET, or Loftus Peak Global Disruption, LPGD. Of the 3, Hyperion's got the best track record over the over time, but I think they're all good managers that you could have a look at. So that's my like high growth bucket.
Nice.
Then I've got another bucket, which is emerging markets.
Yep.
Just because I want some exposure there. And I think one thing we've learnt over our journey is when you're talking emerging markets or small caps, active management plays a role.
Big time.
And so I've gone an active manager here, Fidelity's Global Emerging Markets Active ETF, FEMX. So to recap, that's my core was 60%, and then those 2 sleeves, 10% each.
Yep.
So I've got 20% remaining.
Uh-oh.
And I've just put a bucket here for individual stocks.
Yep.
So with Betashares Direct, I can invest in the ASX 300, and there's some great, really interesting names in the ASX 300. So depending on how the market's going and where I want, if it's risk on and there's growth stocks are doing well, then there's some big names, like REA Group, Pro Medicus, Ordinate, or no,
Maybe.
Is Ordinate in 300?
Maybe. It might be fast falling out.
I don't know. But, like there's those growth stories. Or if it's like, okay, the market's a bit defensive and we just want to invest for income, then Australia's got some of the best income paying stocks in the world, Wesfarmers, Woolworths, the banks and stuff like that. So for me, it's like that 20% is I can try and beat the market. When the market's falling, I can try and limit my downside. And I think I like having a sleeve for individual stocks because it keeps me engaged.
Yes.
Keeps me interested, keeps me across what's happening in markets. And so I would keep the final 20% or $1,000 for individual stocks.
Love it. So just to make it very clear, for Ren, the 60% is the core, and that is where we would be expecting to get the average market return between that 8 and 13% that we talk about time and time again, and then the remaining 40% is where you would be hoping for a bit of market outperformance, but it's not the end of the day if that doesn't happen because you still have the core foundational portfolio sitting there.
Because it kept me engaged and it got the blood pumping, and that's all that matters.
So to close out, we just want to, I guess, touch on the ongoing strategy when once you've deployed that $5,000, because for us, the $5,000 is just the beginning. It's the commitment and the journey that is from this point. And I think what we've learned over time is the more that you can automate that investing experience, the better that you are going to be. And that is because you're going to remove all of the emotion that comes attached to investing, and you're just going to put money into the market at a consistent rate. And so for Ren and I, we both automate our entire process from the moment we're paid. We automate into our bank. Well, we get paid into our bank accounts. It automates through to our broker, and then our brokers have automated investment setup. And so we just choose which ETFs or which stocks to invest in at what cadence, fortnightly, monthly, whatever it is. and away you go. We don't even have to touch it. We get a text message every fortnight saying you've just bought these ETFs, and away we go. And the beauty of Betashares Direct is that it has auto invest as a feature, and we couldn't recommend that more as an investment strategy.
Yeah, take all the thinking out of it. All the, oh, this isn't a good time to invest. Oh, the market's falling. Oh, Trump's declared tariffs. Oh, he's taken tariffs off. Or all the reasons that you would stop yourself from investing, take it out of it. Automate it, because history has shown us time and time again that consistency is the key to long-term investing success. And I think I want to close. I crunched the numbers. So we were talking about a 25-year time horizon here. And I think people, as they get into, their 40s or their 50s and they start seeing the retirement on the end of the horizon, they might start thinking, I've missed the boat. And I want to be really clear that you haven't. So in this scenario, I've taken the last 25 years of S&P 500 returns. So the US stock market, which it was part of our core portfolio with IVV. And I said an initial investment of $5,000 and then $200 a month for 25 years. So that's $2,400 a year plus the $5,000. That works out to $65,000 invested over 25 years. At the end of that 25 years, using real numbers from the S&P 500 over the past 25 years, you'd have $318,000.
Wow.
So you would have more than 5 times the money you invested. That's why it's not too late. That's the power of investing. That's why you've got to get started.
Love it. Well, thank you for the question, Reza, and thank you to Betashares Direct for putting the challenge to us as well. We do really appreciate it. If you want to ask a question, make sure you use the link in the show notes or the description below and leave us a voicemail. If you're just at the beginning of your journey, then we are very glad that you've joined us. Make sure you keep learning along with us and following our journey. Subscribe to the Get Started Investing YouTube that we've just launched, so make sure you get over there and subscribe. All of the content is there in full form, and of course, if you could share this episode with a friend as well, we would really appreciate it. But Ren, that brings us to the end. We'll pick it up next week.
Sounds good.